Are you ready to uncover your retirement solution? Learn more as Keil and his guests guide you along the path of retirement and reveal the 5 steps you need to take to solve your retirement puzzle. Now, on to the show.
Hello and welcome to Retirement Revealed with Keil. Good morning, Jeremy. How are you?
Doing well, Eric. How are you doing?
Oh, I'm excited. I'm excited about the topic. I love taxes. Okay.
Yeah, who doesn't?
I lied. I'm a big fat liar.
Yeah, that's right. I love tax planning. That's what we're talking about. Not the taxes, but the planning.
Exactly. And I mean, it's a subject that people really don't like to have to deal with, which is taxes. But again, tax planning is a whole different story because then you can all of a sudden see, I've got the pieces in place that are going to save me some money and give less to my uncle that's a little shady, my shady uncle there, and keep more in my pocket. So I think the planning part of it is the really exciting part, and the word tax just makes you clench a little bit. But, we're going to talk about it, and this is a great time of year to do that.
Yeah, well, it's not fun when you pay the taxes, but you owe it, so you better pay it.
Yep.
But I think a lot of it has to do with some misunderstandings and maybe some feelings like it's outside of your control. Mm-hmm. There are some things inside your control, and that's what we encourage people to focus on, no matter what topic or area of finance is. Focus on the things you can control, and anything you can't control, just try to bring the risk down in that area. Try to mitigate that somehow. But taxes, especially when we get to retirement, that's something you get a lot more control over than you might have thought.
Mm-hmm. Mm-hmm. Yep, absolutely. And one thing, Jeremy, for my new year, it's not a resolution necessarily, but one of my goals this year, it's a very, very small one, but I'm going to do everything in my power to save about $100 in taxes this year, whether that's just through better planning, through little things that I'm doing. I know that's a very small amount, but my goal is to redirect that $100 to a charity, because
that'd be awesome.
You and I've talked about philanthropic things before, and I know we're going to have other podcasts on that. But I'm hoping that everybody says, the charity that I love and adore, or my church, or whatever it is, I would love to be able to give just a little bit more this year to them, and a little less to that uncle that I'm not too fond of. So that's my goal.
Well, you feel better writing that check, and
Absolutely.
You might feel better writing that check for even a few $100. Than you would writing that check for $100 to pay the taxes.
Well, teach me. Let's go.
Yeah, we're going to go through it. Well, some of it has to do with just some, let's call it maybe a nomenclature is a big word, but just the definitions of some things. And a lot of times when people talk about tax planning or they think tax planning, they're thinking about how do I reduce this year's taxes, which in reality they're talking about how do I reduce last year's taxes. Right? Yep. If it's March or April and you're doing your taxes, that's last year. That year's done. Mm-hmm. Most of the time, you're just trying to make sure everything's correct and so forth. But let's just define something real quick. And we may have mentioned before, we're part of the Wisconsin Institute of CPAs. And this isn't even just a financial advisor thing. This is also a tax person situation, that there is a difference between something called tax advice versus tax planning. And let's just talk about that real quick. So,
please.
The idea of tax advice, that's helping you fill out and make changes to your current tax year. When your tax advisor, right, you go to your CPA, your accountants, they're giving you tax advice when they're helping you fill out last year's taxes. Or maybe you're someone that owns a business or is setting up a business, and they're giving you advice on you should do this type of retirement plan, or you should incorporate your business in this certain level. That's actually tax advice. When they can tell you, here's the dollar amount to the penny, how it's going to affect you, and it involves tax forms and things like that. And a lot of times it's either kind of current year looking or looking at last year. Mm-hmm. In tax planning is when we make some assumptions about your situation and just see how could this affect you over your whole lifetime. And that's where we feel you can get the biggest bang for your time, biggest bang for your buck, is to focus on the tax planning. Usually the rest of your life is going to be longer than last year, right? So let's take a look. When someone like your financial planner, someone like us says, hey, you got your required minimum coming up in 10 years, it might push you to another higher tax bracket. Let's do something about it now. I mean, that's some really forward thinking if we're making some decisions that might affect you 10 years down the road. But in reality, if you don't make those decisions, it's still going to affect you 10 years down the road or longer. Yeah, so you might as well make decisions that you've thought through and you've kind of weighed the pros and cons. And that's the tax planning part of it that we like to focus on.
Yeah. Well, that's the best place to start, I think, right?
Yeah, and that's just kind of creates a little bit of a problem almost in a way when people feel like they're doing tax planning when they're talking to someone that's a tax advisor. So sometimes we'll talk about tax planning, and they'll say, "Oh, I got my accountant. He did my taxes last year." Okay, that's great. You want your taxes done correctly, but if your financial advisor or your tax person, whoever it is, isn't talking through your financial situation and how it might change and how that might project out into the future and how actions you can take today can affect your future, that's not actually tax planning. And it's the tax planning that we like to really help you figure out and make some decisions on.
All right.
Yeah. Yeah, another part of it, again, just kind of these definitions, but it's so important, is a couple words. You might have heard of some of them, but there's your tax bracket. A lot of people, I think, have heard of that.
Yep.
There's your effective tax rates. A lot of times your accountants, your tax person will give you your tax returns, and they'll say, just an example, let's say you had $100,000 of income and you paid $8,000 in taxes, in federal taxes. They'll say, oh, you had an effective tax rate of 8%.
Yes.
And you might hear that and feel like you're paying taxes at an 8% rate. You might be in the tax bracket of 12%, and that's just the way that the U.S. tax code works, where the first few dollars pays a lower rate, and then the next few dollars pays a lower rate, and then as you make more money, those next dollars pay a higher rate. And that's where we get into the concept of something called marginal. Marginal taxes is saying, if I take this action, if I have an extra $1,000 of income, or maybe I have an extra $1,000 as a deduction, how is the taxes going to change on that specific $1,000? That's called the marginal rate. So just to think it through, a lot of clients that we have, let's just say your income's about $100,000. You're getting close to the top of that 12% bracket. Let's just pretend you just hit it. You hit the top of the 12% bracket. Well, the next bracket's 22%. So here you are. You think, I'm in the tax bracket 12%. Maybe your tax person figured out and said you paid $8,000 in taxes, so you have an effective tax rate of 8%. But in reality, your marginal rate, right, the next $1,000, if you made $101,000 as an example, let's just say this next $1,000 goes into the 22% bracket. Well, now that $1,000, that $1,000 itself, you paid $220 in taxes on it. That's a 22% marginal tax rate on that specific decision, on that specific dollar amount. And that's the one that really matters. That's probably the one you see the least, but that's the one that affects you the most. And that's what we really like to key in on, is what is your marginal tax bracket, what is your marginal tax rate, and how will it change based on certain situations or certain decisions you make.
Gotcha. Okay.
It's a little complex, but our hope is to simplify it down, help you make some different decisions. And one of the key ways to do that is just to look at how will my taxes change when certain points in my life happen, right? A lot of people are not yet retired. They probably want to retire, right? Your taxes will probably change before retirement and after retirement. Oftentimes with retirement, you get onto Social Security. Your taxes will probably change before and after Social Security. Later on, you might get to what used to be the age of 70 and a half. They just changed this tax law in December 2019. Now it's 72. So the age of 72 is when you start the required minimum distributions. Your taxes might change before that happens and after that happens. And the one that a lot of people don't realize or plan for is the fact that your taxes will probably change when there's two of you, when it goes down to one, right? We get into our mid-80s or around 90 or so, and perhaps somewhere around that point in time, the first person in the couple dies. Very, very unfortunate, obviously, but from a financial standpoint, your taxes change as well. You're no longer married. You're now a single individual, and your taxes are going to change then. So we can somewhat look at these crossover points and say, what's going to happen before and after retirement and so forth, and see how's this marginal tax rate going to be showing up. And I don't know about you, but I think if I see a marginal rate that's lower than the rest, I'm going to try to pay taxes at that rate versus another one.
Yeah, definitely.
Yeah, so let's just go through and talk about what happens before and after you retire and all those different areas.
Okay.
Right? So where this gets a little bit interesting and new for folks, right? We work with people all the time that are preparing to retire. We like to help you retire and stay retired. is the way we like to talk about it.
Yeah.
So if you're not yet retired, you haven't hit that yet. You've had 30 years, 40 years of kind of the same thing. And in a way, the same thing is you make your salary, you have some deductions perhaps, you fill out your taxes. It feels like you can't really change it, right? But after retirement, you can change a lot of things, right? So before you're retired, you got your 401k, IRAs, different things that maybe can affect your deductions. But after retirement, you get to choose when your income shows up in your tax return. You know, if I walked into my boss's office and said, hey, can I work this year, but you pay me next year? That probably isn't going to fly. I think actually tax-wise, it's not going to fly either. But when you're retired, you can call up your 401k or call up your IRA and say, hey, it's 2020, I need some money, but I'm going to take it out in 2019. Or you can make your taxable income show up in 1 year, but actually use it the next year. Or perhaps you do the opposite. You can use some money in 1 year, but push out the taxes to another year, right? If you take money from your savings account, you're not paying taxes on that. And then maybe the next year, you replenish that, right? If I need 10 grand out in December, I could take it from my savings account and then call up my IRA in January and replenish that. Well, it's next year that the taxes are going to show up. So you have a lot of control in retirement, and that's just something that people aren't used to, is the fact that you get to control your taxes before and after retirement. So that's just kind of the first concept that we want people to understand, is you can control your taxes quite often in retirement, and it's making decisions on when do you have income showing up or when do you take deductions. You can even move your deductions around a little bit.
Yeah, and I think that's the biggest thing that people probably don't know, is that they have more control than they think.
Yeah, that's exactly it. A lot of times that's, you can get some psychological and, philosophical debate here, but the idea is you do have a lot of control, and understanding that and making use of that, you're going to come out ahead in the long run for sure.
Yeah, absolutely. So what's next?
Well, another big one, oftentimes you retire and then you hit Social Security. We encourage people, and of course we have a Social Security episode talking about that, so go back and check out that episode where we dive in for about half an hour on Social Security. But the idea is you can take Social Security when you want to, and oftentimes you end up delaying Social Security because your taxes will change before you take it and after you take it. And it's so odd, and it's really where this marginal rate comes in. It's just a very odd way that they figured out how to tax Social Security. What they do, and they came up with this back in the early 80s, they say that this thing called provisional income. Like, we'll tax part of your Social Security dependent on, let's do a formula first and figure out if we're going to tax your Social Security, and if so, how much of it. So they do this formula. Trust me, if you don't have a tax person by the time you go on Social Security, you'll want it just for this, right? And they'll figure out and say, well, your Social Security amount, whether it's 10 grand, 30 grand, 50 grand a year, either 0% of it will be taxed, up to 85% of that Social Security will be taxed, or anywhere in between.
Up to 85%?
Well, up to 85% of it becomes taxable. Your tax rate is actually different. So
okay, that scared me.
Yeah, people hear that and they think 85% taxes. It's actually 85% taxable.
Taxable, got it. Okay.
Yeah, yep. But what that means is that your $1,000 of Social Security, that might show up as zero on your tax form, might show up as $850 in your tax form, or anywhere in between. And this is where we get a little danger coming in from this idea of, oh, I've got an 8% effective tax rate. We'll just go back to the example earlier. Or I'm in that 12% bracket. Well, we see this a lot with our clients, especially when they go from being married to single, right? You might have been in the 12% tax rate when you're married, but we'll talk about this later on. Your tax rates will change, your tax brackets will change when you're single. But let's just talk about, we see this all the time. Got a couple clients I'm thinking of right now. They're at the top of the 12% tax bracket, and they're maybe at the 7, 8, 9% effective tax rate. So you kind of figure, oh, I take $1,000 out, and my effective tax rate's 8, 9, 10%. So that's what I'm going to pay my taxes on, right? Not quite the case. So when you pull out an extra $1,000, if you're at the top of the 12% tax bracket, guess what? You're actually at the bottom of the 22%. So that $1,000 will come out at the 22% rate, right? Because you if you're at the top of 12, you're actually at the bottom of 22. So you probably didn't know that till you fill out your forms and you find out what bracket you're in. But what's worse is the way that this whole Social Security taxation comes in. That $1,000 of IRA money or taxable money, whatever it was, that will probably kick in more of your Social Security being taxed. So we'll go for the extreme example, which we've seen a lot. We see this a lot of times, again, with widows especially. A lot of times it's the wife. But that $1,000 of extra income all of a sudden brought $850 more of your Social Security into the tax form. So it's not the $1,000 that shows up, it's $1,850 that shows up on your tax form. And because you're at the bottom of the 22%, you thought maybe you're paying 12% taxes. No, you're at the bottom of the 22%. You're paying 22%. Well, we'll do some quick math in our head, but 22% times the $1,850 is about $410.
Yeah.
So all you did is you took out $1,000. You're thinking that $1,000 is going to show up in your tax form, either at your effective rate, which is maybe like 8, 9, 10%, or at the tax bracket that you know you're at the top of at 12%. But no, it's actually $1,850 that got kicked into the 22% rate. You pay $410. That's a 41% marginal rate. That's where we see it so often. The swing of where the marginal rate is far higher than what your actual tax bracket was. That's a big deal. And I use some examples, again, extreme example, but we see this all the time. And it all depends on a lot of factors on how much your Social Security is already taxed, where do you take your money from. But we just wanted to really highlight how important this crossover point is of before you take Social Security versus after you take Social Security. Your marginal rate is going to wildly swing. We see that so often. You might want to run your tax forms through some planning software.
Yeah.
Talk with a person that knows what they're doing as a tax planner to help you figure this out. Because by the time you hit April and you fill out your tax forms and your taxes are higher than you thought it would be, and it's a little too late. It's too late by that point.
Well, and that's just it. I mean, nobody likes surprises like that, right? I mean, surprise, you won something big. Great. Surprise, you just paid a lot more in taxes. Nobody enjoys that. So, yeah.
A couple more times these crossover points. We're just trying to see, okay, did the marginal rate go up or down? Well, whenever it's down, that's when we encourage you to pay some taxes, and let's break it out. But here's another one that oftentimes the marginal rate goes up, and people are making decisions that are almost going to push the rate even higher. It's unfortunate, but you've heard of required minimum distributions.
Yes, absolutely.
Yeah. So it's the idea of any money that you got this tax deduction on, right? A traditional 401k, a traditional IRA. You got this tax deduction when you put the money in. Well, guess what? You got to pay it back, or you got to report it, show it up as income, rather, whenever you take the money out. So people retire 60, 62, 65, and they tell us all the time, I got to figure it out. I'm just going to live on this dollar amount, and I'm going to wait to take out my IRA, wait to take out my 401k until they force me, right? I don't want to do it, so I'm going to wait till they force me. And I don't know about you, but my kids don't like to be forced to do something.
No. Yeah.
Yeah. It doesn't change at 18. When you become an adult, you still don't like to be forced to do something. That's why a lot of people we talk to don't like to be forced to take out these required minimum distributions. But usually when you do something because you want to, you feel better about it. And you probably are getting a better tax situation in this case, right? If I'm 65 and I don't need to take the money out, but I do it anyway, well, why did I do it? Not because I'm forced to, but because I figured out the tax situation's better to take it out at 65 versus at what's now 72 for the required minimum. So it's unfortunate. A lot of people say, I'm just going to wait. I said, wait a second. So maybe it's 10, 12 years from now before you're forced to take it out. You want more money in your accounts by then, right? Yeah, I want more money. So you're going to wait to later on when you have more money that's taxable to take your money out versus right now when it's perhaps smaller and pay less taxes on a lower amount. Let's figure this one out. Let's look at what your marginal rate will be before required minimums, after required minimums. And if you've got a lower marginal rate today, why don't we take the money out? And there's so many different ways you can do it, but why don't we take the money out now before you're forced to because you want to. And you want to do it at that point because you've done the planning and you figured out it's better off for you.
Well, and that's it comes down to one word for me. It's control, right? You have control. You are in control. You're just not some passenger that is strapped into this thing that you just don't know what's going to happen. You have the control. It's just like you brought up the kids, right? It's when you force them to do something. I've got some grandbabies now, and my granddaughter loves to play with beans. and it's a very tactile thing, and they have trucks that they
Sure,
drive through it, and they but when it comes to pick those beans up, man, it is the worst experience of her entire life. She just can't understand why she has to pick up all these beans. Well, she's lost control at that point, and I'm forcing her to pick up the pieces, right? And that's what nobody wants to do with their taxes. Don't be there just to try to pick up the pieces. Control the scenario from the get-go. And wow, the confidence level that you have, I think the psychology of it, we could dive into that conversation for hours. But that's good. That's really good.
What's a new thing? And it's like we said earlier, you had 40, 35 years, whatever it is, where you didn't have much control over your taxes. But here you are with all these different situations. You got control over the rest of your life, and a lot of it has to do with when you choose to pay taxes. So here's the last one. Here's one that's not the one we want to talk about. It's not fun to talk about, so usually people ignore it, or they're kind of surprised by it, and hopefully you're surprised by it ahead of time so you can do some things about it. But when there's two of you, your tax bracket's different than when there's one of you. And a lot of people retire, and they're married, and they've spent their life together, and they understand that they want to spend their retirement together, but at some point you won't be, right? Somebody's going to pass away first. Yep. And we'll talk about a lot of clients we run into. We're just rounding some numbers here, but a lot of clients, you're a couple, and let's say you're making like $100,000, just making some round numbers. When you make $100,000 as a couple, you're probably in the 12% tax bracket. Especially when you're retired, you're probably in the 12% tax bracket. And the way the tax brackets work, which is complex, there's books about this, but the way the tax brackets work is at that point, roughly half your income is at the 12% bracket. So some of it's at nothing, some of it's at 10%, and like half of it's at 12%. Well, when the first person dies, the tax brackets actually get cut in half. So even if you make less money, and that usually happens. Number one, the first Social Security, the lowest Social Security rather, that goes away. So this couple making $100,000, top of the 12% bracket. The widow might drop down to $85,000. Might drop down less. Well, let's just go with $85,000. Well, now they have less income, but they're not in the 12% bracket anymore because the tax brackets got cut in half. They went from having half their money at the 12% rate to half their money at the 22% rate. So we see this all the time.
Okay, Jeremy, what you're saying is that when one spouse dies, they get the higher of the two for Social Security, correct? So if a spouse, and traditionally, I know that historically, men have worked higher paying jobs just because that's kind of the way the world has been working for decades. They're the main breadwinner traditionally, and so they usually have higher payments for Social Security. So when let's say it's the husband was receiving $2,000 and the wife was receiving $1,000, that's $3,000 altogether. But if he dies, she begins receiving the $2,000, right? But loses the $1,000. So her income goes from $3,000 to $2,000. Correct? Is that what you're saying?
Yeah.
Okay.
That's exactly it. And it's a little bit more complicated than that, but I love that example. That's a great way to go about it. Another thing, too, just to look at the traditional part. Traditionally, a lot of the husbands are a couple years older than the wives. So traditionally, the husbands get to a higher amount first because they're just older. That's just kind of the way life has seemed to work out. Starting to change a lot right now, but still a lot of people that are retiring today, 60, 65, they're somewhat close to that traditional idea. But either way, no matter what it is, if you have two Social Securities, one goes away when the first person dies. It's the lower one. Doesn't matter whose it is, but the lower one goes away, which means oftentimes we're thinking of this couple that we have so often we're working with, where combined they might be making $100,000. Roughly speaking, they're at the top of the 12% tax bracket, which means roughly half their income is in that 12% tax bracket. And we can kind of think of why. Let's just try to draw out a picture in a way, is that let's pretend the government looks at these two people, at 100,000, two people. It's like they're both making 50. Right? It doesn't matter if they're both making 50 or if one's making 100, that was making 0. But they kind of say, oh, you're making roughly 50. And for single folks, when you add in the deductions and so forth, that's like the top of the 12% bracket. That's kind of why combined, roughly half their income's in the 12% bracket.
Got it.
So that couple that beforehand was making 100, it's like the government looked at them as two single folks making 50 in a way. But when the first person dies, even when their income drops, let's just say it dropped from 100 down to 85. Well, now there's that one single person now. She's filing as a single person, making 85, and she's got a lot of income above that point where it turned from 12 to 22. Roughly speaking, it's like half your income went from 12% as a married couple to where roughly half your income is in the 22% bracket as a single individual.
Yeah,
and that's why a lot of times you have people that lower their income. They have less income as a widow, and their taxes go up. It's unfortunate, but that's just kind of the way the tax system works.
Yeah, it's almost a penalty, right? It's a penalty for somebody dying, and that's hard. And the thing that bothers me is, a widow, right? She's a widow. Yeah. She's just going through this tremendous, or a widower. Either way, anybody who loses a spouse is going through a tremendous turmoil, and they have to make huge adjustments in their life, and now they're going to be charged more in taxes. Ugh, just getting kicked while you're down.
Yeah, and I don't think it was intentional. And really, how can you come up with a system that's perfectly fair all the time for every situation? But now you guys know about it, and hopefully this is like the last thing that happens as part of your retirement and a change there. This is way down the road, but we'd rather you figure this out now as you're planning for retirement versus the widow finds out about it, the April, year or two after the spouse dies. Like, wait a second, I have higher taxes. Well, you're in the different tax bracket now. And we talk about this, unless you run the numbers, and we like to run the numbers for it. People say, we can live on less because there's one of us. Well, your property taxes didn't change. Or, we'll make less so the taxes will go down. It actually went up when we figured it out. Unless your plan is for your spouse to live on exactly half, which I hope is not your plan. Yeah. Right? I hope you're leaving your spouse with more than half your income. Your tax bracket's probably going to change. So let's do some planning on that. Like you said earlier, take control. If we can project this out, let's take some control. And when you have that lower tax rate, that lower marginal situation, if there's two of you and it's a lower marginal rate, let's pay taxes on purpose at that lower amount because you might have projected out and seen, it'll be higher later on. Let's pay taxes now while there's two of us at a lower rate when we can afford it to help out that widow later on so that they aren't paying those higher taxes later on when they're forced to.
Yeah, that sounds like a good plan. Jeremy, I know we're running low on time today. Is there anything in closing that we really need to be thinking about?
Yeah, we use this word control a lot, and control the things you can control. We talk about that all the time. That's a big deal. You can control so much. Focus on things like your tax planning, not your investments. You can't control what's going to happen in the world. You can't control what's going on in the stock market. But when you hit retirement, you can control a lot about your taxes. And it's really looking at what's your marginal, that word marginal, figure that one out. Marginal rate before a certain event and after a certain event. And then you can take some control and pay taxes on purpose on the lower rate versus when you're forced to, perhaps, at the higher rate.
Gotcha. All right. Yeah. Fantastic.
Hey, it's complicated stuff, but it's fun to talk about the planning part. It's more fun to plan out than it is to actually pay the taxes. So make sure you're working with someone that's a good tax advisor, but also a good tax planner. We talked about the difference, advisor versus a planner. Yeah. But you need a good tax planner too. It might not, probably not going to be the same person. That's okay. But if you're a tax person, if you're a financial person, investment guy, whatever it is, if they aren't talking about this stuff, we don't think they're doing their complete job. You need this kind of help.
Yep, absolutely. And speaking of which, two things. I want to make 2 points here. For the audience, you need to understand that Jeremy has done this for a very long time. And the best part is that he is not an accountant, right? But he works with accountants, and he will work with your accountant. He will work, it makes the team better when someone can kind of orchestrate and kind of be the coach of the team, bringing all these pieces together. So talk to him about that. And speaking of talking to him, Jeremy, how do they get a hold of you if they do want to have this conversation?
Yeah, easiest way is to come check out our website, keilfp.com, Keil, that's how you spell my last name, FP for financialpartners.com. A lot of good information on there. And the top right is a button that says Start Here. So if you're looking for a good place to start, we got a Start Here button for you. Easy enough.
Right. Easy.
Or you can pick up the phone. It's 262-333-8353.
All right, my brother, this was a great podcast. Great information. And my biggest takeaway is my tax planner and my tax advisor, probably not the same person. I never really thought of it that way before, and that's given me a lot of food for thought. So thank you for that, and I appreciate your time.
Absolutely. Thank you, Eric.
You bet. And thank you all for listening to the Retirement Revealed podcast with Jeremy Keil. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when Jeremy comes out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your friends and family. Again, this is a great one to share because, especially with your spouse, this conversation needs to happen. It's a great time of year for it, and the planning can begin now. Again, thanks so much for listening today. For everyone at Keil Financial Partners, this is Eric Johnson reminding you to live your best day every day, and we'll see you next time.
Thank you for listening to the Retirement Revealed podcast. Click on the subscribe button below to be notified when new episodes become available. Visit retirement-revealed.com to learn more. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Keil Financial Partners. Keil Financial Partners does not provide legal, accounting, or tax advice. Consult your attorney or tax professional. Representatives have general knowledge of the Social Security tenets. For complete details on your situation, contact the Social Security Administration. Keil Financial Partners is a part of the Thrivent Advisor Network, a registered investment advisor. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.